Welcome to Ansell's 2020 Virtual Capital Markets Day, and thank you for joining us. I am Anita Chow, Director of Investor Relations and Treasury at Ansell. Having postponed this event from earlier this year due to COVID-19, we're delighted to be here today, albeit virtually, to update the investment community on Ansell's strategy and what you can expect from the company over the next few years. Over the last few days, key members of Ansell's executive team have recorded their presentations. Most of these executives are live on the webcast from various locations around the world, including New Jersey, Brussels, and Malaysia, to answer your questions. Before we begin, I would like to point you to our disclaimer, so if you can please take some time to read that. At any time during the webcast, you have the opportunity to ask a question. Your questions will be put forward to the executive team during the Q&A session at the end. We also have some analysts who have dialed in, and they will be able to ask their questions via the teleconference. These instructions have been provided on slide 3. After the conclusion of the event, we encourage you to reach out to our investor relations team with any follow-up questions you may have. The agenda for today's session is displayed on screen. You will hear us cover topics including the impact of COVID-19 on the PPE industry, the targets we committed to at our 2017 Capital Markets Day and what we delivered, the actions Ansell has taken or will take based on its experience, what sets Ansell apart from its competitors, and what Ansell's new targets are for the near to medium term. Before I hand over to Magnus Nicolin, our Managing Director and CEO, we will commence with a short video.
"2020 placed Ansell directly on the front lines of the COVID-19 health crisis. As the world braced for the impact of the pandemic, we were tasked with making extraordinary efforts to step up and help. Applying experience gained in January at our facility in China, our teams worked tirelessly to set the standard for safety and ensure that our plants around the world were operating, even as other companies were forced to shut down. We maximized supply despite unprecedented disruption, reconfigured our plants with new safety protocols, and expanded production of single-use chemical and surgical gloves, as well as suits. Despite many COVID-related challenges, Ansell delivered a strong business performance in F20, with sales increasing 9%, EBIT up 21%, EPS up 24% on a constant currency basis, and cash conversion of 118%. The last 3 years have now delivered annual EPS constant currency growth at double-digit percentages, and cash conversion has exceeded 100% on average for the period. This consistently strong performance is allowing Ansell to step up our investments and, more importantly, our ambition level for long-term PPE industry leadership. All of this has been made possible by a very deliberate strategy to make Ansell an innovation and manufacturing powerhouse. Over the last 10 years, we've focused our portfolio on safety solutions, securing the number 1 or 2 position in each segment worldwide. We built the most recognized and trusted brands like HyFlex, AlphaTech, Microflex, and Gamex, and expanded our global sales force to more than 800 staff with an emphasis on emerging markets. We are now leveraging our master data to deliver solutions to customers worldwide through new digital channels, increasing self-service access and readily available safety advice. This strategy has been fueled by investments of more than $1 billion in M&A in life science, body protection, mechanical, chemical, and single-use gloves, and $500 million invested in manufacturing and IT. This was financed by a combination of consistently strong cash flows and divestment of non-core businesses such as sexual wellness and rubber boots. The recent completion of our transformation program achieved a smaller footprint of larger world-class manufacturing facilities, and it is in these plants that we have now increased investments and capacity further. The past year saw a significant increase in capital equipment investment from $42 million average annual spending to $65 million in FY20 and a projected $95 to $105 million in FY21. Signature investments in the production of mechanical, single-use, chemical, electrical insulating, and synthetic surgical gloves, as well as body protection and clean room packaging, are now being completed in 6 countries. In addition to these investments, Ansell acquired a 50% stake in the Malaysian surgical and exam glove supplier CarePlus in February, providing additional capacity precisely when it was needed most. Ansell has become a unique integrated innovator, manufacturer, and marketer of differentiated products, opening new doors that will accelerate growth of sales and profitability in the coming years. We have also been able to advance our CSR and sustainability agenda. Our shift away from oil and gas burners to biomass and solar power, and our focus on decreasing water usage have been taking center stage. Our commitment to the safety of our workforce also remains steadfast, and lost time to injury rates have remained low. With an incredible 89% participation rate in our 2020 employee survey, our scores moved up 900 basis points to world-class levels for a manufacturing company. The unwavering dedication of our employees, particularly during times of crisis, is what makes Ansell, Ansell. Combined with our world-leading brands, strategic investments, a strong balance sheet, and recurring cash flow, we will continue to set the tone for the PPE industry now and when COVID-19 is behind us, all while delivering shareholder returns that few others can match. Welcome to Ansell's 2020 Capital Markets Day.
Hello, everybody. Delighted to be back talking to you about Ansell. Let me dive right in. As you know, Ansell is a safety company, and we will talk about many of these dimensions of safety and how we run this company, but it's all about safety, well-being, and peace of mind globally. That's our mission. When it comes to our setup as a company, we've seen a small shift over the last few years to healthcare from industrial. So we now have 45-55 balance. And you will hear from my colleagues about the different SBUs and how they're developing. But fact is, we're now a $5 billion market cap company with focus on 100 countries and with a strong presence around the world. When we turn to the economy and the macro, the environment we play in, we have seen, of course, a significant impact from COVID. In that the global economy has slowed down dramatically. But as you see on this chart, that was quite temporary. And we're seeing it pick up again, not all industries, but most of them. We see governments providing stimulus, industrial production rebounding, and we do see some uncertainty with the US election. And we expect COVID-19 flare-ups to come in and out of the marketplace for the next 12 to 18 months. But all in all, it's going to be an environment where we can be very successful. When it comes to the different verticals or activities, you see a number of them with a net positive feedback here in green. Some of them, we have both positive and negative aspects. And of course, some of them where there's a direct negative, like in aerospace, for example, it's obvious. But as you can see from this chart, there's more positive than negative, and hence Ansell stands to benefit from an environment that requires more protection, generally speaking. We have been very deliberate about our strategy over the last 10 years, for as long as I've been here, and it's been focused on optimizing the portfolio to make sure that we're number one and number two in everything we do. That's been paramount. And to do that, we've acquired businesses for $1.1 billion. We divested non-core businesses for $600 million. And we've essentially ended up with a strong portfolio of safety businesses. We've also supplemented that with significant investments in manufacturing and capability and capacity, and in patents and trade secrets. And we do have a plan where we manufacture our differentiated products in-house, and we source some that are less differentiated. And we do it with really strong attention to CSR practices. We also drive our brands. And today we have 80% of sales from our top brands. We have expanded our sales force. We've expanded the focus on digital. And of course, Guardian underpins how we sell and how we interact with customer. And that has allowed us to become a fully integrated innovator, manufacturer, and marketeer of differentiated products, where we have a number 1 and number 2 position in everything we do in the global marketplace. So a strong position to move onwards from. When it comes to our commitments at our Capital Markets Day 3 years ago, we said we're going to grow 3 to 5%. We have grown 4.5 CAGR during that time. EPS, 5 to 10% growth. We have grown 17.5%, similar constant currency CAGR. ROCE, we said we're going to do 14 to 15% return on capital employed. We delivered 14%, and up from 2.3, so a big step up. And cash, we simply said that we were going to generate a lot of cash, and we have indeed seen our cash generation grow, CAGR 10% per year. So I would declare success and essentially say that we have delivered what we said we were going to do. And that has transferred into the nice development of our share price in the last 3 years with a 23% CAGR. But perhaps more importantly, our 10-year CAGR is now 13%. So I think we're demonstrating that we can deliver value at the double-digit level, TSR level, year on year for a long period of time. And that's an important element. So that leads to the question, can we continue to do this? And what is the impact of COVID? So to answer those questions, we're going to be talking about the 8 points of differentiation. And my colleagues will go into a little bit more detail on what the GBUs, SBUs are doing and strategies. We'll talk about our operations supply organization, and of course, our regions and sales organization, how we're optimizing them, and of course, how our passionate people will drive this forward and do it in a sustainable manner. So here's our 8 points of differentiation. I've shared this with you before, and it talks to the different areas where we're looking to separate Ansell from the competition. Since I will talk to them individually, let me jump into them. But as you see, we have the 8 points, and at the center of it all, we have Ansell safety and the employee passion that is so vital, as well as our sustainable practices. So these in combination are building the moat around Ansell and makes us achieve a competitive advantage that is sustainable over a long period of time. So the first dimension is sales, and we built up the sales force. We now have 170 sales reps in the BRIC countries. As one example, we continue to invest in differentiation through Guardian, and it's a powerful tool and quite unique in the industry. And we're expanding on the digital capabilities. So when it comes to customer intimacy, we have a strong position, we believe, and a strong sales force. Number 2, product and technology. 80 new products have been launched in the 3-year period, and we continue to invest in R&D for further innovation, and we'll cover that a little bit later. 300 plus patents filed in the 3-year period. And here you see a couple of examples of really important products that are in the market and doing extremely well at this point in time. When it comes to brand awareness, we are focusing on the 4 main brands, HyFlex, AlphaTech, Microflex, and Gamex. And we've seen our sales from our top brands, including some of the other important brands below, now above 80%. When I came to Ansell, it was 45%. And we had 250 brands at that time, so we've come a long way, but we also have some ways to go. When it comes to geographical coverage, we have, as I said before, invested in emerging markets, and you see it here in the form of some pretty good results in Russia and China, India, Brazil, with good CAGRs in terms of growth, and where we also have launched a number of products adapted to the specific needs of these emerging markets under the Edge brand, and invested in warehouses and support infrastructure. We're also doing quite a lot of work to respond to increasing nationalism by local, if you will. And that need or that trend has accelerated through COVID and for healthcare products, where a lot of governments would like us to build plants in Europe or in the US, and if not plants, a capability to service in an organized way. We have responded. We are building a plant in Russia, and that goes back a couple of years when we started that project. We're expanding in Portugal and a couple of other places. So it's a really important move to have a stronger footprint locally. When it comes to regulatory, it is a strong point of Ansell. We are working very closely with regulatory bodies around the world, everywhere from China to Europe and the United States. And to make sure that we understand what is coming and that we have the right products when new regulations hit. And it's an active dialogue, and we are able to guide our customers to make sure that they are compliant. And the new regulations in Europe are particularly demanding in requiring retesting every year and so forth. And many customers are struggling with that, distribution partners, if you will, and we need to help them. So this is a very important advantage for us. When it comes to manufacturing, a lot of focus on that. You remember a couple of years ago, we went through transformation, simplified the footprint, shut down a couple of plants, expanded others. And now we have dramatically stepped up our investments in these fewer, bigger plants with huge initiatives to dramatically expand capacity in Bangkok and Vietnam and Sri Lanka and so forth. And these are very efficient locations with good labor costs, but above all, a really good labor pool with strong capabilities and good engineering teams and so forth. So all in all, significant investment and yielding strong position and rapidly increasing capacities, especially now more recently of single-use and chemical suits that are, of course, in high demand. And we also do that with a strong focus on CSR practices to make sure that our employees are well taken care of and given the appropriate recognition and compensation, as well as high quality housing and so forth. Very important to us, and we also demand of our suppliers to respect that. When it comes to supply and delivery or our global supply chain, a lot of work is going into this right now. We are investing in increasing safety stock. We are changing the max load that we put on the plant, so we have a better ability to respond to wins in the marketplace, if you will. Systems are improving, processes are added to, and we've also upgraded our teams. So this is a very important area of focus for the company at this point in time. And then finally, making sure that the business is digitally enabled. And a lot of initiatives. We simplified our websites from 40 to 1, available in 24 languages, but a very consistent look, if you will. And a whole series of initiatives to make sure that our assets are digitally enabled, meaning there are videos and photos and everything that a distribution partner might need for a catalog or promotion is available in a clean digital form, easily downloadable and so forth. And our asset base is now quite strong and is allowing us to support our distribution partners really effectively. So when it comes to the center of our little circle of differentiation, CSR and sustainability is a key focus for the company. We've used this kind of graphic to illustrate how we are working for a better society. for employees, community, and just generally when it comes to business ethics, which includes not price gouging in times like the ones we're living through right now. Better environment, water use. We use a lot of water, so reusing water is a key part of our investments, energy and waste. And then finally, of course, better business for our customers, for our suppliers, and for you, our investors, to make sure that you get the return that you're looking for. So this is sort of the summary perspective of the sustainability model that we have. We've also made a number of changes to our teams. Circled here in red are recent additions to the senior leadership team of the company. And in green, we have our two successor candidates to CEO, both sitting in the GBU leadership roles, and several comment on developing well. All in all, I must say, the leadership team of the company today is the strongest it's been for as long as I've been here. And I'm delighted with how the team is working together and getting the job done. On succession, we are moving ahead. As you know, we extended it by 6 months to give the board a chance to properly evaluate our candidates, and they are making good progress. And the board is expected to take a decision in the first half of our F22. And we will also do an upgrade to our compensation principles and designs at that point in time. So that's what's coming. So finally, let me wrap up on a little bit of more forward-looking perspective. So from a macro point of view, slowdown is impacting certain industries, as we talked about, and will continue to do so, whereas other industries are returning to growth very rapidly. When it comes to COVID-19, it has changed behaviors. There are increased safety requirements, and a lot of our customers have upgraded their protocols for how safety is managed and who must be protected with PPE. We're continue to see various aspects of the aging global population, for example, driving increasing demand for our healthcare-oriented products that will continue with or without COVID. Obviously, digitalization is a big trend, and we're investing heavily in that. And sustainability is what we need to practice, and we're pursuing that with vigor. And when it comes to go-to-markets and needs, automotive is changing, and it's a shift to different types of gloves, less oil protection and more electrical protection, as an example. But we don't see the spend on gloves go down for the typical automotive company. It is more the mix of different products. Chemical is very complex, and we expect that continue to gain further in complexity, and hence the need for Ansell to step up and provide advice. In the medical space, a shift away from natural rubber latex to synthetics continue, and in some cases accelerates. We also see the industry consolidating, both on the manufacturing end and on the distribution end, and that is good news for Ansell, because when it consolidates, we typically win by signing global deals and so forth. And we do see emerging markets continue to evolve and requiring more dedicated support, and that's why we have invested in more sales capability. And what about COVID-19? What is it then doing to our markets? Well, first of all, safety products have been strengthened, and we expect more usage of safety products in a lot of different verticals, so higher demand in many verticals. We see procedures, activity, and frequency of use increasing in other types of applications, especially across the medical spectrum. We see in surgical a temporary dip as elective surgeries were canceled. And what we've seen is a queue, a lineup of people waiting to have surgical procedures. And it's going to take several years for the hospital systems around the world to eat into that queue of people waiting. And for that reason, we're going to have strong demand for surgical for probably 2, maybe 3 years. Emerging markets practices are becoming more similar to mature markets. As an example, and many of you know this, the number of gloves used per capita in Asia is 80% lower than glove use per capita in North America. And we see that gap narrowing primarily with Asia using more and more. So that's going to provide a natural demand increase for many different products. And then globalization is being thought about a little bit differently. We've been on a globalization journey for the last 30 years, and now we see a stronger push to, yes, global by all means, but also with some local quick response capability. And hence, we do expect further investments in local manufacturing or partial manufacturing around the world to complement the big global centers. And finally then, key priorities for us, first of all, keep our people safe so that they can deliver safety solutions to the world. And we're going to do that by driving growth in a number of different areas, by sales excellence, tools, capabilities, training, allowing us to lead the industry with the best coverage and best sales force. Innovation, significant innovation in latex formulations and layering, in yarns, in smart PPE, software-driven solutions to track products. And you're going to hear more about that from Neil, more on the formulations from Daryl. And we expect to launch improved solutions for chemical hazard and ergonomic injuries that are growing rapidly. We continue to invest in manufacturing, and we continue to build a stronger supply chain, and do all that with a strong focus on sustainability. And with that, I'm going to be handing over to my colleague Daryl Nazareth, who will take you through the plan of attack in the healthcare business unit. Thank you. Daryl?
Greetings, everybody, and thanks for listening in. My name is Daryl Nazareth, and there are 3 things I would like you to take away from this presentation. First one is innovation and strengthen our portfolio is what's driving our growth. We have the broadest portfolio and the most innovative, and that's number 1. That's what's driving our growth. Number 2, we're investing in a very big way because we have confidence in our growth trajectory. And number 3, we service a set of customers in a diverse customer base who are global, and they're present in counter-cyclical industries that is largely insulated from the macro economic downturns that are being experienced. Okay, so those are 3 takeaways: innovation, strengthen the portfolio, we're investing in a big way, and number 3, we're largely insulated from those major downturns because of our presence in counter-cyclical industries. Okay, moving on to our vision. This is very important. It's all about providing high quality, highly reliable service to our customers. Okay, this is number 1. This is all we're about. This is our vision. And we have an innovative suite of products to provide those customers. We have 3 underpinning strategies. Number 1, grow and strengthen our core business. Number 2, deliver high value products and solutions. And number 3, go and invest in areas that are rapidly expanding in new markets, new segments, new geographies. And we do it with our people, the collective energy of our people, their energy, their excitement, the teamwork and execution. So this is the way we run the healthcare business. Moving on, like I said, the business is what we're focused on. It's basically 3 product lines, 3 portfolios. Examination is the largest one, followed by surgical, followed by life sciences. We have global brands. We have a global presence. North America is the largest market, as you can see from the chart. Our brands include Microflex is the #1 examination brand in the world, Gamex, and BioClean. And then we have a very, very diverse customer base. As you can see, we have acute care, we have alternative care customers, we have industrial customers, we have surgical customers, we have food customers, life sciences customers. It's a very, very diverse customer base, okay? All right, moving on. A little bit about what has transpired since the last Capital Markets Day in 2017. Since that period of time, we have grown at a CAGR, a 3-year CAGR of 6.7%, and reaching 895 million in fiscal year 20 just ended. And our EBIT margin has increased to 15.9%. And there are a few drivers here, and I'll go very specifically through some of the drivers of how we achieve this. In the exam portfolio, #1, some very cool new technology products were introduced that really added to our growth in exam. Now, we also acquired some new products that strengthened our presence in emergency management services, first responders, ambulance, veterinary, dental, these sort of alternative care applications. #3, COVID. COVID was a big driver. This past year, COVID increased the demand of a lot of our examination products. And then #4, we added some capacity to improve our service, and that's really boosted the amount of examination products that we can sell in the marketplace. So exam has really done well. Surgical is a little bit different. Surgical, a lot of our efforts to accelerate surgical were through improvement in quality, through improvement in process technology, through improvement in increasing capacity and productivity, making our products more competitive. We improved our synthetic and NRL portfolio. We reorganized the sales teams around the world. And that's how we grew surgical. We had some new products as well in surgical. And so productivity, innovation, quality is really what accelerated our surgical growth. In fact, COVID, it's important to say, COVID actually had a negative impact on surgical, but in spite of that, our surgical business continued to grow. And then life sciences, we've invested heavily in life sciences by adding resources around the world in life sciences. It's been a truly great business, a double-digit growing business, and we're continuing to invest in life sciences. So that's really what's happened, to drive that 6.7% CAGR, and we see continued momentum in the business. We are investing in each one of these portfolios, and we'll see more growth from each one going forward. Okay. Next, a little bit about our markets. Okay, we have about a $9.5 billion addressable market across the 3 portfolios. But the exam portfolio is more targeted towards the specialty exam area that we play in and we do so well in. But let me say something about each portfolio and their market presence. Each portfolio is growing faster than the market. Okay, that's #1. #2, we have leading positions in each portfolio. #1 or #2 positions. We have a #1 position in exam. We have a #1 position in surgical. We have a #1 position in life sciences and gloves, right? And in each one, we're investing in innovation. And we have internal manufacturing capabilities in all of them, Surgical is 100% internal. Exam is growing, by the end of this year, it'll be about 50% internal. Life sciences is 100% internal. So we have very, very strong presence here, and we're growing faster than the market. Moving on to the next slide here, just talking about some of the trends. Many of these trends you're probably aware of, so I'll go through this very quickly. Aging populations, Magnus talked about that. Affluent customer base in emerging markets that are seeking healthcare services. Infection prevention has always been part of healthcare, but with COVID, it's become even more greater. There's always new regulatory drivers. Everybody's looking for allergy-free, skin-friendly solutions. And then in the industrial space, people are looking for more value, higher performance, less cost. We have great new chemical protection solutions to take advantage of those. So those are some of the trends that are out there in the market. And the pharma industry, as you know, the pharmaceutical industry, the vaccine industry is extremely busy. You know, it's important to say that. They're all very busy creating new vaccines and pharmaceuticals, and we have a great set of products to service the pharmaceutical industry with relationships at some of the biggest pharmaceutical companies in the world. Moving on to the exam portfolio and some of the change in the business landscape. It's important to just touch on this for a few moments. As you know, and you've all read the papers, the examination glove market has increased quite substantially in size. There's a sharp demand, high increase in demand, 2 to 3 times the increase in demand. Glove dipping companies, glove manufacturers have run out of capacity. In fact, they're adding more capacity to keep up that demand. And that in turn has exhausted the raw material capacity to make those gloves. So you've had an effect throughout the industry all the way down to the raw material, where the raw materials will take a significant amount of time to catch up to the demand that is required. And then lastly, there's been cost escalation in the labor force with the need to protect factory workers, the availability of factory workers, the need to protect them while they're working, social distancing rules that limit productivity. So these are all the issues that have manifested themselves in the last 8 or 9 months here, as COVID has taken a big impact on our examination business. Moving forward, now I've told you about what we've done since the last Capital Markets Day. We've talked about the business landscape and some of the trends. We've talked about our own position. But now I want to switch gears and talk a little bit about those 3 strategies that I started off with. Okay? Number 1, grow and strengthening our core business. Okay? For us, this is all about the focus on quality, capability, capacity to service our customers. Okay? And we are laser focused on this. We have confidence. I said earlier, we have confidence in our growth. We have confidence in our portfolios. And that's why we're investing. We're investing $80 million plus, in our factories, in technology, getting new process capability, making our plants more productive. And we're investing in each portfolio. We're investing in exam, we're investing in surgical, we're investing in life sciences, because each portfolio is growing. Okay, so that's our number 1 strategy. And along those lines, we're investing in new technologies, so those factories are more productive. And that's really key. And those factories being more productive, they make better quality products as well. The second strategy, moving on, is delivering high value products. This is all about innovation. Innovation is key to us. Innovation is what brings value to our customers. This is key, and it's what differentiates us versus our competition. And we've got some blockbuster products. The reason why we have number 1 or number 2 positions is because we have strength in the portfolio, and that is a result of innovation, and we never forget that. We'll continue to invest in R&D, invest in engineering, and invest in our factories. We have great new products on the Gamex product line and surgical PI hybrid, polyisoprene hybrid. We have highly tactile, high strength products. In examination gloves, we have the best chemical performance products on the market. And in life sciences, we have some unique designs for our garment portfolio that make product protection even better for the pharmaceutical industries. So innovation will continue to be a key focus of us, and it's a key pillar of our strategy. That's number 2. Number 3, moving on, is investing in market segments that are fast growing or geographies that are fast growing. So here we're doing many things, okay? We're focused on emerging markets like rest of Asia, China, India. We're investing in those markets with resources. We're building tailored portfolios for those customers in those markets. We're even investing in manufacturing footprints in those markets, you know, because we believe that those markets are important to us and those markets are growing for us. We're also investing in high growth segments like life sciences. Life sciences is our fastest growing strategic business unit. It's our fastest growing portfolio. We want to add more capabilities, more products. We want to build out the toolkit even more. We want to give our salespeople and marketing people in the regions more to sell. And we want to gain, you know, a greater share of our customers' wallets. So those are the three strategies, okay? Growing and strengthening our core, that's number one. Number two, delivering high value products and solutions to our customers. And number three, invest in fast growing markets and segments. And that's it, you know, just to wrap up, you know, and the last slide here, like I said before, we have a very strong and diverse portfolio. We have leading global brands, diversified customer base. We're investing, we're growing. We're investing because we have confidence. You know, we have confidence in our growth trajectory. We have momentum in our business. We're investing in factories. We're investing in R&D. And what's more important at the end of the day is our people. We're taking care of our people and making sure that they work to realize the vision and enjoy what they're doing. This is really, really key. And then lastly, it's important to note, which I said in the very beginning, we're fortunate to be playing in with and servicing customers, diverse customer base in industries that's largely insulated from many of the economic downturns. You know, we play in counter-cyclical industries. It doesn't mean that we do not have tight competition and we do not have issues, but we are largely insulated. And the strength of our portfolio, the innovation, the investments, the brands, that's what keeps us competitive in the marketplace, and that's what differentiates us as a business. So with that, you know, thank you very much for your attention. Now I'll just turn it over to Neil Salmon, who will talk to you about the Industrial Global Business Unit. Thank you, and have a great day.
Thank you, Daryl. So it's 18 months now since I transitioned my CFO responsibilities into the capable hands of Zubair and focused on my current role as president of our Industrial Global Business Unit. So let me begin by summarizing for you our purpose as a business and where we stand in our ability to deliver on that promise. Our purpose is to reduce injuries and occupational illness amongst workers worldwide. And we do that through unique differentiated products that improve safety, but also productivity and are a pleasure to wear. And we're increasingly focused on the importance of information that's beneficial to workers, their supervisors, and our distributor channel partners on ways to reduce injury risk to hand and body while improving productivity. What do we mean by differentiation? Well, it's the 8 dimensions that Magnus covered earlier. So where do we stand as a business? Well, we've accomplished significant change and transformation over the last couple of years, and I'll summarize that for you in a moment. Going forward, I now think we're better placed in the next 1 to 2 years to grow ahead of market rates. And beyond that, I think an accelerated growth rate is achievable through innovative solutions addressing major continuing causes of injury in the workplace. And I'll describe those opportunities later. So the last 2 to 3 years has been heavily focused on strengthening the core and foundation of the business. The next 2 to 5 years are about building a higher growth business. So a couple slides summarizing where we stand as a business. So our main product category, gloves, sleeves, chemical protective clothing. We have a very even global presence. Mechanical is our larger business, but a very promising chemical business as well. Importantly, we're now consolidated under these 5 key global leading brands. In terms of market exposure, yes, around 60% of our end customers are exposed to the industrial production cycle, but many customers in other verticals are seeing elevated demand right now and are not subject to that industrial production cycle. And then around 30% of our products are also seeing elevated demand for sanitation and viral protection needs. Summarizing our markets and our position in the market, mechanical, around a $4 billion total market, but where we actively compete, $2.7 billion. That market growing around 2% per annum. And our share, and this is by some margin the market leading share, is 17%. In chemical, a $2.7 billion global market, a slightly higher growth rate at around 4%. Here again, we are the leader in chemical hand protection, but we are the number 2 player in chemical body protection and overall a number 2 market position. So key changes since the last Capital Markets Day, and I summarize that under these 3 headings here. Firstly, brands. A big change for us. We had a very wide range of small brand positions previously. We've consolidated that now into 5 key global brands, and they together represent around 80% of our sales. And our flagship brands, HyFlex for mechanical, Alphatec for chemical, both exceed $200 million in sales and are the leading brands in their space. Significant work accomplished on manufacturing transformation. Our footprint has been consolidated into leading global facilities. We've delivered on our transformation savings goals. But in F20, we still weren't realizing the full benefits of our new footprint, and so there is further opportunity there. And we've continued to focus on product differentiation. We've successfully expanded to adjacent products through acquisition. For example, protective clothing more than doubled since the Microcard acquisition, and promising signs from our acquisition of the Ringers Impact range. And we've continued to focus on innovation through our 8 R&D centers and continued product launches around 10 to 15 products per year. Over this time period, our financial results around a 2% organic growth rate. That's in line with market conditions, but going forward, I think we have a higher growth rate attainable. I'm also satisfied by the EBIT margin improvement, but as I mentioned, F20 didn't yet fully benefit from our new consolidated manufacturing footprint, and so there's EBIT margin opportunity as well. So why do I believe we're now well positioned for improved growth? Well, let me comment on the markets that we're in, first of all. And certainly in the short term, there is quite some significant dislocation and different factors going on in different markets. Yes, mechanical PPE used in the manufacturing sector, such as automotive and aerospace, is seeing declines year on year, but that is offset partially by strengthened demand from other verticals. Within chemical, we're enjoying increased PPE usage in support of sanitation and viral protection, and that's more than offsetting weakness in traditional industrial verticals for chemicals, such as chemical manufacture. Longer term, we expect steady category growth at or above GDP rates. But I believe we're positioned to grow above that rate through leveraging our new, stronger brand positions, our new differentiated platform technologies, through continued opportunity to globalize our acquired product adjacencies, impact protection and protective clothing in particular, continued share gain opportunity in emerging markets. We continue to build out our sales presence there, but going beyond that to a technical presence and also local manufacturing where that makes sense. And our improved manufacturing base has achieved both improved productivity, but should also result in a more reliable and high quality supply chain, and that should benefit top and bottom line growth. And finally, we're investing behind this growth opportunity. I mentioned already investment in innovation. We have significant additional capacity in place, and more capacity is coming online during this current fiscal year, targeted to our higher growth opportunities. And finally, we're starting to invest in partnerships that strengthen our ability to tackle major unmet industrial safety challenges. And I'll focus on those over the next few slides. So there's three major areas where we still see unacceptably high rates of injury to workers in both mature and emerging markets. And they're summarized at the center of this circle. Hazardous substance exposure, the fact that workers are often injured because they're not wearing the right PPE at the moment that they need it, and ergonomic injury. And the circles around show how the product solution can help prevent against these injuries, but then the outer circle is the information solution, which we're increasingly focused on now. So let me walk through each one of these in a little more detail. Hazardous substance exposure. So the statistics are stark in the world on the incidence of occupational illness arising as a consequence of workplace exposure to hazardous substances. People often think, well, that must be what you breathe in that creates the risk. But the data actually indicates that it's exposure through the skin that could be the bigger source of injury. Often the worker is completely unaware that they are exposed through the skin. There's no physical indication until sometimes years down the line that you have been at risk and that you have absorbed a harmful substance. So what's the product solution to this? Well, we're launching to the market now unique differentiated products that have a much wider range of protection. So protecting against more chemicals for a longer period of time, combining chemical protection and cut protection, chemical protection and fire protection, so that a single product has a much broader range of benefits to the worker. There's also an information challenge here though. Data is widely available on what happens when one chemical is exposed to one piece of PPE and for how long a worker is protected. But that's not a very realistic simulation of an actual workplace, which is much more complex and dynamic than that simple model. So what we're doing at Ansell is building unique capability to help safety managers understand the actual risks that their workers are exposed to. Through analysis of that data, the combination of chemicals, the combination of PPE, the tasks that workers are doing, we're able to give specific advice to safety managers on what they need in their workplace to keep their workers safe. That information is useful in driving market share of our protection products and may also have a commercial value, which we're testing in the market right now. Turning now to the risk of workers being injured while not wearing PPE. And again, some stark statistics here. There continue to be more injuries to the hand and the arm than any other body part. And 70% of those injuries could have been prevented if the worker had been wearing the right PPE. So why don't workers wear PPE at the moment they most need it? Well, often the products are inconvenient, they're uncomfortable, and they get in the way of doing other tasks. So how do we address that challenge? Well, by making our products super comfortable, but also making them more useful. So some of our products actually improve worker productivity. We're pioneering touch screen capability so that our products always work reliably with the touch-sensitive devices that workers are now using through manufacturing facilities. And we're also combining different types of protection into one product so that you don't need to take on and take off gloves according to the workstation you are. You get a wider range of protection all day against all hazards. The information solution is about warning workers of when they are inadequately protected. We've launched our first products today where the machine won't run unless it detects that the worker is wearing the right product. In other cases, it's about creating a workplace environment where information is sent to the worker on the hazards that they will experience in that area and whether or not they're wearing the right PPE. And we're piloting that approach at the moment. Ergonomic injury is one of the most intractable causes of injury in the workplace. Ergonomic injuries typically result in significant medical treatment, and that's expensive and increasingly expensive with an aging workforce, which many countries are experiencing. Ergonomic injuries also result in more time away from work than the average injury. Traditional PPE is sometimes a cause of ergonomic injury, particularly if it's stiff, inflexible, and increases strain on the hand or the body through wearing it. So the product solution is to remove that factor, to make sure the PPE is very comfortable, very flexible, that has improved grip, which then reduces the strain necessary to grip objects during a working day. But here I think the information solution could be the bigger piece of the puzzle and of the solution. We've developed a packet of sensors that can be integrated into the glove or worn on top of the glove that provide data on hand and arm movement to safety managers and worn on the kinds of tasks in the workforce that will lead to an increased incidence of ergonomic injury. We're piloting this right now with several customers globally. And the information we're getting back from safety managers is that for the first time, they now see the data that they need in order to modify working conditions and job tasks to eliminate the causes of ergonomic injury. And that could be very significant for injury rates in the workplace. So let me conclude by recapping on investment themes in our business. So first of all, our end markets remain attractive and provide good opportunity for growth. We've completed significant transformation work, driving efficiency and also enabling future growth. And I think we now have an enhanced ability to transfer all the potential within our business to customer value through those PPE-enabled information solutions that I've described, but also through being more effective in sales excellence. And that's the topic that Renee and Ricard will cover next. Finally, a word on acquisitions. We remain focused on the opportunities that acquisitions could bring. Our primary goal will continue to be buying businesses that, as part of Ansell, strengthen our overall capability to deliver organic growth in our markets. We've seen success with this approach with the MicroGuard and Ringus acquisition, and if we can identify other businesses that fit into that model, then we will happily continue to build our business through acquisitions as well. Thank you for your attention, and now I'll hand over to Renee and Ricard.
I will talk about what we are seeing in the market recently. But before we go there, just a few words on how Ansell stands out in the eyes of our customers. And I think it's really three things. You heard Magnus talk earlier about our 8 dimensions of differentiation. In the eyes of the customer, I think there's 3 that I really want to highlight. First of all, our geographic reach. We are in over 100 countries, and this is important because more and more our customers are getting increasingly globalized. Secondly, our product range, over 1,000 products across our categories. This means that for virtually any application, any problem that a customer has regarding hand protection or body protection, we can find the right glove, sleeve, or suit for that application. And finally, customer intimacy. While we predominantly sell through distribution, we've made deliberate investments and efforts over many years to develop the tools and the footprint to stay very close with the end user, because that's really where the decisions are made at the end of the day. And obviously, Ansell Guardian and Ansell Cares are key pillars in this strategy. So with that, let's take a look at what we have seen in our PPE market in the past 6 months. And first, we'll go back a little bit what we saw early in the pandemic times. So literally overnight, there was a spike in demand globally. And when you combine this with also some disruptions in the supply chain, whether it was curfews and lockdowns or closed borders in some cases, PPE export regulations, raw material shortages and whatnot, it really led to quite a severe shortage of product in the marketplace. This in turn led to rapid price increases and attracted also, quite frankly, a few luck seekers. So we've seen a lot of traders come into the market trying to make a profit from PPE. We've seen some cases of products being sold with not the right or even falsified regulatory certificates. We've even seen counterfeit product and outright scams. And lately, one of the categories that's been mostly under pressure is the single-use gloves category, where it takes quite a long time to ramp up production, and production is also concentrated to relatively few countries. If we then fast forward a bit to what we're seeing today and what we expect to see going forward. So there's a gradual reopening of our customers' activities, kind of hand in hand with the reopening of society. And whether it's automotive manufacturing or elective surgeries, it varies a bit by segment and also by geography, but the trend is clearly towards slowly but steadily getting back towards pre-COVID level of activity. And one thing that's very clear is that whenever people come back to work, they're very careful about wearing and using PPE to protect themselves. So while there in many cases might be fewer hands in an automotive factory, all those hands are now protected by gloves. And we see increased scrutiny and new PPE protocols and also enforcement in place. We also see quite a few new users of PPE. So it might be consumers such as ourselves. And my wife today knows the difference between an FFP2 face mask versus a surgical face mask, which was not the case a year ago. We also see many governments being quite active in trying to build or rebuild strategic safety stocks to protect their populations. So all in all, the market is kind of finding a new balance here. We see that we could expect that there will be continued excess demand for single-use gloves in particular, higher than the ability to put new capacity in the market in the short term. This means that a new price level has been established, and almost every supplier today has gone to product allocation, which means that you can't necessarily buy exactly what you want to buy, but more what your quota of what you're allocated to buy. And one other thing that's very clear is that also by having a diversified portfolio, players like Ansell are benefiting, because while there's differences in how our end user segments are faring, we can shift our resources, our focus, and also in some cases we can shift product volumes between different markets, different geographies in order to balance this. Plus the fact that we have in-house manufacturing has really shown that we control our destiny, and our customers see that firsthand, and they appreciate that we have full control and insight over what's being produced today and tomorrow, rather than only relying on perhaps outsourced manufacturing. So that's a short intro on what we're seeing in the market. Now I will leave over to my colleague Renee Larry, who will talk more about Ansell's response in these times.
Thanks, Ricard. It's a pleasure to talk to you today about Ansell's dynamic response to the multitude of market conditions that we've faced and we continue to face. It's certainly been an intense period, as we've had to quickly adjust our pricing for our single-use exam and body protection product portfolio to really ensure that we maintained profitability. And we were one of the first in the market to implement price increases and surcharges. And while it's never a fun conversation with customers that you're increasing prices, we really had a clear story that we were able to deliver, and we had strong evidence that validated the reason for the increases. And then with demand skyrocketing, as we heard from Ricard, for a large part of our portfolio, particularly single use and a finite amount of supply, we had to focus on ensuring that we had the right processes in place for product allocations. We committed early on to ensure that we supported our long-term strategic customers, and we also looked at our frontline healthcare workers, our emergency response workers, and essential services to ensure that we were allocating product to the most important customer groups. This has really served Ansell well, as our customers really depend on us for consistency and reliability. We made that decision not to be opportunistic, to really make sure that we were supporting the customers that we've spent years building that relationship, and will continue to work in partnership in the future. And throughout the pandemic, we recognized the need to keep our customers regularly informed on the situation, which was very dynamic. And the communication on allocations, supply impacts, product availability was a really important tactic in maintaining trust and support from our customers. And we were commended from many customers for our transparency and honesty, as they're having to communicate the same messages to their end customers. So we've stayed very closely connected with regular communications, whether it be webinars, letters, emails, phone calls, to make sure that they truly understand the situation. And with supply constraints in single use, we've pivoted to promoting our chemical hand protection solutions. which is much more readily available. But it also provides excellent virus protection as well. And in fact, there are cases where this is actually a better solution. And there are really good examples where we can show that it has an environmental improvement benefit, right, using less disposable gloves, but there may in fact also be a better ROI from a cost perspective. And then government agencies all around the world established task force to really ensure that they understood what was happening in the PPE market, and most importantly, helped work with companies like Ansell to understand how they could fast track product into the market. And then, so with so many businesses shifting to either a work from home environment or really limiting or completely limiting representatives to be able to visit their sites, whether that be a hospital or a manufacturing location, we swiftly transformed our selling organization into an effective virtual selling machine. This is really thanks to the fact that we have tremendous selling technology platforms. We've got great digital assets that we were able to leverage and quickly set up things like customer webinars. We conducted thousands of webinars around the world with our distributors and also end users. It was actually a unique opportunity because it was almost like we had a captured market. There are a lot of people working from home, and a lot of sales leaders decided to allocate, you must do a certain amount of hours of training, per week. And so it was terrific to have the level of engagement from our distributors where we could really talk about the full portfolio we have. We could talk about new products, we could talk about existing products. So just a great opportunity there. And then you'll be familiar with our Guardian online safety tool that really helps customers walk through their environment, and it provides recommended solutions based on each application and risk. And we were able to shift our sales force to actually conduct virtual Guardians. So that's where the Ansell representative was working from home, online, on the laptop, video connected with their customer. The customer's walking through the site, really looking at the risks, really looking at the different types of applications. And then we were able to collectively work with them to produce the right recommendations from the Ansell portfolio. We also amped up our social media to really act as an industry thought leader and provide suggestions on the most appropriate use of PPE. And as we did this, it attracted a lot of great attention. We're also able to direct those folks directly to the Ansell website and to our PPE resource center. And we took the opportunity to leverage those leads in partnership with our inside sales team, really to be able to continue to develop those relationships. And our nimble and responsive approach has enabled Ansell to take advantage of the new opportunities that have been created as a result of the pandemic. And it's been very satisfying for us to be able to continue to support our customers and help them navigate through these challenging times. I'll now hand over to John Marsden, our Senior Vice President of Operations and Supply Chain, who's led an impressive team effort to continue to produce and provide and deliver our much needed products to our customers around the world.
Thank you, Renee. Hello, my name is John Marsden. I'm proud to work for Ansell, and I'm proud to serve in the Ansell supply chain. I want to talk to you about 3 broad strategies to deliver sustainable business growth. First is a focused investment in our network. The second is improving the assets that we deploy to face the future challenges. And the third is to continue to evolve our organization to orchestrate that network to sustainably serve. Let's think about our network first. Ansell comes with an enviable network that is truly global, built through organic growth as well as through acquisition. Through the transformation program, we have built centers of excellence across our technology bases. COVID-19, the global pandemic, has put a shock through all global supply chains. And we need to think about resiliency in a different way. And therefore, as part of our design, we've been building in, particularly where we have single sources of supply, how can we increase the resiliency? How can we duplicate our manufacturing footprint so we can produce in more than one location? We're also seeing the trend for localization, and we are eager to pursue market opportunities by looking at where we produce in new locations for Ansell. We're also putting a different design rule over the way we construct our networks, with a capacity utilization to reset to allow short-term volatility as well as the headspace for long-term growth. To do that economically by sweating the assets that we have, by swapping out and debottlenecking our assets, as well as putting in new assets and new capacity. We've got a capacity cell whose only job is to look to that future so that we're making the right decisions in a timely way to always allow for sustainable growth. Let's just remind ourselves about Ansell's global network. Our network stretches from the east coast of Australia all the way to the west coast of America. We produce in 9 different locations. We have 13 manufacturing facilities and 28 distribution centers all over the world. And we're proud to say that we will be in production in Russia through this financial year. But we're not stopping there. Here you can see where we produce our key technical categories. Here you can also see where we're investing for capacity and for resilience. And we've got activity now running in most of our locations, further strengthening, giving unique breadth and enviable depth across our network. Within that network, we're also reimagining the assets that we need to serve the challenges for the future. We know that the old adage of free labor everywhere no longer holds. We have seen the race for talent in all ends of the skill spectrum, be it for very advanced mechanical work, all the way to the advanced skills that we see within our network base. The race for talent is there every day and is getting stronger. We're also seeing the need for digitalization. As our products become more complex, to match with evolving regulatory base that we see across the world, and to be able to manage both the individual machine level all the way to a network in real time. And to do that with a manufacturing base that reduces our environmental footprint. So let's look at some details about how we're doing that. We've had a program running called Productivity 2.0, which means a step change in our productivity levels across our manufacturing base. And that is bringing together the best of Ansell, our long history of advanced engineering with bringing in new technologies. We're also looking at digitization. Obviously, the new assets we're putting down are IoT, IR 4.0 ready, but we've got a deep program to make sure that we're retrofitting all our brownfield assets and networks. Some of the automation challenges are going to be data heavy and data intense. Visual recognition, handling of thin films requires lots of data processing. And therefore we're bringing together our technology stack from the data warehousing, the ERP systems, the end-to-end, so that we can record and analyze and understand and develop business intelligence that directs us more quickly to the right solutions in the future. On sustainability, we have a 3-pronged approach. 1, to reduce our inputs or to switch our inputs to greener alternatives. 2, to run an efficiency program through all our locations, running thousands and thousands of projects to improve each individual part of efficiency within our manufacturing base. And the 3rd is making step changes in the way we produce, to make a step change in the effectiveness of our processes, working collaboratively with R&D and partners internal and external to Ansell. I want now to look at Productivity 2.0, which is the centerpiece of our program for improving our manufacturing productivity. We have, over the last year, analyzed all our processes, looked at the applicability of automation, the difficulty of doing it, and what are some of the technical challenges that we have to face. Also looking at the size of the prize, what is the opportunity that we can release by making each one of those process steps. automated, and more productive. That comes together in our technology funnel, which assesses the size of the prize, the size of the difficulty, and phases out the work, because we have a number of unique technical challenges that, with the enhanced skill base within Ansell, as well as working with key technology partners, we are piloting, we are proving, and we are deploying at pace. Using the experience from the transformation program, we're managing those hundreds and hundreds of projects with an integrated project management system. And that leads us on to the third part of our strategy, which is investing in our organization. And Productivity 2.0 is a good example where we're investing with R&D and with engineering skills and new talents to solve the problems of tomorrow. Engineering has long been a jewel in the crown of Ansell. We have a long track record of delivery. We're increasing the engineers who are responsible for delivery of the capital projects in line with the increased capital spend that you heard about and will hear about through this whole presentation. We're responding, building, and bringing new capacity into the Ansell network. And we can do it stronger and faster together across Ansell. With our unique blend of different products and different technologies and manufacturing processes, we can reapply these solutions in innovative ways and synergistic ways to go faster together. Now, with that new asset base, that new evolving technology, we also have to upgrade the way we do things in our factories, and we call that our Ansell production system. Again, we've got a great history of working in Lean and Six Sigma, but we're broadening that to take care of the highly advanced assets that we're laying down. This approach will be standard across all our factories and will, at the heart of it, be people-centric, so we can skill our people for tomorrow's challenges and to bring tomorrow's solutions. Stepping back and thinking the whole supply chain, we've come now together under the Ansell supply chain. Plan, make, source, and deliver. One team whose focus is to sustainably serve our customers, to serve our business. Brought in new talent, pinpointed leadership talent to unleash the experience and the breadth and depth and talent that we have within our organization. And to support that with new end-to-end planning systems and business intelligence solutions to unleash that white-collar productivity, that white-collar creativity, to orchestrate our deep, deep network. So, we're building on our network, making it more resilient and bringing new capacity to face tomorrow's market demands. We're improving the quality of our assets to again face those future challenges, and we're evolving our organization to make sure that we in the Ansell supply chain can sustainably serve. I'd like now to hand over to my colleague Amanda Manzoni, who will take us through our program on corporate social responsibility and sustainability. Amanda.
Thanks, John. And it's an absolute privilege to be here today with you for my first Capital Markets Day in Ansell. And it's also a privilege to be able to share the material that I'm going to with you on our people and sustainability journey. And this is one that we're very much on and which is very much going to move ahead. The eagle-eyed amongst you will notice that this slide has already been shared today by Magnus earlier in the presentation, but I wanted to share it again because it really encapsulates what Ansell is trying to do as a company, and that we're way beyond just the profits. And it's our role to make sure that we are thinking about society, our environment, as well as, of course, the business. And that really is at the heart of everything that we do. And Magnus introduced this slide originally internally, but it has such an applicability to share more widely now as we evolve our journey. And I'll now talk in a bit more detail about that journey and what we really mean, because it's fine to put it on a slide, but it's not what you say, it's what you do. As you are all aware, the issue of human rights in manufacturing, and particularly in certain industries, is rightly under scrutiny. Ansell has always wanted to do the right thing, and particularly when it comes to human rights, we continue to do that. Our journey on this started several years back, and some of you will have heard about it previously, but we continue to learn in this space, and we continue to do the right thing and to try and help drive the industry further. So we've had a very clear framework, which is we've put in place very strong governance, a very clear intent, and we're now measuring that. And we measure it, and we also take actions where we recognize that we've not got it right. As a learning organization, we have to keep taking sources of advice from external as well as from internal players. And we continue to do that. And now I'm going to talk a little bit about our environmental side of the business. And again, the storyline is the same, which is this is really important to us. It's not a journey that we've just begun. It's a journey that is continuing, and very much one where we set a baseline, we're very honest about that baseline, and we're now seeking to improve. And on this slide, and it's a busy slide, I recognize, you see our committed targets, but the targets are just one thing. The really important stuff that we're doing right now is really drilling down to the individual location level to make sure that we've got the actions that are going to deliver those eventual targets and will actually build us out further. Now, our intent in this space is also really key. And I'll give an example of that in terms of whenever we're making CapEx decisions, whether that's expansions of existing facilities or whether it's a totally greenfield expansion, as we've heard about today, we use this as our guiding star to make sure we're doing the right thing, which is not necessarily the cheapest thing, or not necessarily the thing that will immediately give us the results we want, but it's doing the right thing for the future. And of course, now as we turn more back to people and to our workforce, I thought it useful to share with you our metrics about how diverse our workforce is. One of the things that struck me immensely on coming into Ansell was just, for the size of company, just how global and diverse it is. And that's truly wonderful. However, diversity in and of itself does not drive business value and creation. However, if you can harness that diversity, that really does give us a differentiator. And so this year we have revised our diversity and inclusion policy and plan and issued those. And now we're in the process of operationalizing it, and very much with the focus on inclusion. How do we build an organization, a culture that is filled with individuals who not only survive in the company, but really thrive. And they want to be there because they're valued, respected, and called upon to develop in a way that is right for them, that recognizes their individuality whilst pulling towards the common good, which is also the business good. So yeah, very proud of that and what we're doing and seeking to achieve. And then finally, how does some of that come together? And I'm really firmly of the view that we can have the best technology, we can have as much money as we need, we can have the best anything, but without the best people and without us investing in our talent, that is what will make the absolute difference. You've heard about our 8 points of differentiation, but as you know, right at the core of that is our talent and our people. And top to bottom, we are there to make sure that those folks develop in the way. So it starts at the individual level with the culture that we create, that everybody is encouraged to develop and learn. And we've put in place a new Ansell University this year, and we are trying to create that sense of curiosity and learning, because that will help us innovate for the future. Now, we also know it's about the quality of our leadership. COVID has really shown us the importance of our local leaders. What happens locally is really influenced by the local supervisors. And so we've revamped our leadership programs, starting at the supervisor level, to enable us to build out that agility, the ability to communicate, the ability to be responsive to the needs of the business now and ahead. Similarly, you have to look now at your talent, and it's fine to have a great talent pipeline that's there now, but you have to look out a number of years. And we have a talent review process that enables us to do that, and which we continue to invest in, to say, okay, we know what we've got today, we know what we need tomorrow, and we need to also be planning for tomorrow's tomorrow when it comes to our people and giving them the skills that they need. And then I mentioned COVID, and one of the things that we did overnight was we moved to a virtual way of working for a large part of our workforce, and that digitally enabled way of selling, etc. But what we now know is we've had this wonderful gift of, we can do something here. We've opened our eyes and seen stuff that we didn't think possible. We now need to harness that. So throughout F21, a really key area for us will be about building out our digital and analytics capabilities, starting from the customer back. And that's one that I hope in a year's time to be able to tell you some more exciting news about. And with that, it's my pleasure to hand over to Zubair, who will talk to you more about the financials. Thank you.
Thank you, Amanda, and welcome to the finance section of this Ansell 2020 Virtual Capital Markets Day. Over the next few slides, I'll cover a summary of our financial performance over the last 3 years, and this will include achievement against key metrics such as sales and earnings, as well as how we've managed against our capital allocation framework, which of course includes returning cash back to shareholders. And then I'll wrap up with our medium-term financial targets. So, beginning with sales performance on the first slide, you heard from Magnus already. We communicated a goal of 3 to 5% organic growth back in 2017, and after nearly 8% growth in fiscal 20, we're pleased to have landed at the top end of this target at 4.5% compounded growth over that 3-year period. You've also heard today from Daryl and Neil the major themes occurring within both the healthcare and industrial business units, and it's good to see a path for outsized sales performance, or at least when comparing to our usual GDP benchmarks. In respect to earnings, if we exclude the impact of foreign exchange, we've grown earnings before interest and tax close to a 10% compounded rate over the last 3 years, with additional sales volume, transformation benefits, and disciplined management of SG&A expense all contributing there. And then lastly on this slide, on a constant currency basis, we've delivered EPS, or earnings per share, at a CAGR of 17.5%, and with share buybacks adding an extra lift there in the growth. Switching to cash, you hear us mention this often, but it's worth repeating. Ansell is a company with very strong cash dynamics, both in terms of operating cash flow, as well as the percentage of cash we convert from earnings in the first place. And as you see there on the left, the last couple of fiscal years, we've driven a notable step up in both cash generation at $192 million in fiscal 20, as well as cash conversion of 118% or so in the same fiscal year. This is why we keep a focused eye on quality of earnings, as well as a keen eye on management of working capital. The chart in the middle shows how we've returned some of this cash back to shareholders, and it's in line with our usual stewardship. If we have excess cash, we do look to return those funds as efficiently as possible to shareholders, and you see that evidence with $600 million returned in the last 3 years. That, of course, includes some of the proceeds from the sexual wellness divestiture from a couple of years ago. And then finally, on the slide here on the far right, you see 170 basis points of improvement in our ROCE, or return on capital employed target. And in fiscal 20, we landed right at the base of the 14 to 15% target range, landing at 14%. And this is a target we set ourselves back 3 years ago. Moving to the balance sheet, I discussed this in our full year earnings call a couple of months ago, and highlight again, even through the pandemic, our liquidity and cash balances remain robust, They still remain robust, and this is with very little net debt to EBITDA, and at 0.6 turns, as you see on the slide, we've considerable headroom to deploy against future strategic investment opportunities as they rise, and yet still maintain our investment grade rating from Moody's. With that type of balance sheet and cash generation, our first priority, as always, is to reinvest funds internally. And in the next slide, you see here, after several years of about $45 million of CapEx spend, we've ramped up growth investments in fiscal 20, and again, we'll look to double down further in fiscal 21. Our engineering teams, as we speak, are navigating COVID travel protocols at the various manufacturing locations, and providing we don't have any new restrictive lockdowns, we do anticipate between $95 and $105 million of CapEx spend in fiscal 21. You've seen from the other presentations today the key areas where we're investing some of this money, but whether that's increased capacity, productivity improvements. On the next slide, you do see here we consistently achieve high returns with these types of investments. So as an example, something like the surgical synthetic expansion or an expansion in rubber insulated gloves or rigs, these types of investment not only enable us to go after fast-growing markets, we also achieve improved mix and better gross margins with this type of investment. And at 40, 50, even 100% plus returns with a short payback period of less than 3 years or so, we continue to encourage all our teams to generate and execute against these types of ideas. This way, we're confident that we maintain Ansell's competitive advantage long into the future. Alongside these types of internal investments, on the next slide here you see we're also not averse to inorganic growth options, and here on this slide you see the M&A deals we've executed since the last Capital Markets Day. And I'd say they've all added nicely to our strategic market positioning, whether that's in emergency medical services with this small DigitCare acquisition, or protecting against impact injuries with the Ringers acquisition, or even indeed the life sciences clean room capabilities through the Nitrotex acquisition. Most recently, we've also found joint ventures can make a lot of sense, as evidenced by this very timely CarePlus deal, as well as supporting aspirations within our surgical business unit. This has really helped us get a much needed boost in supply capacity of single-use and examination products, and this obviously helped with the pandemic-driven demand. The next slide summarizes our capital management framework. I've just spoken about CapEx investments and M&A, but here I make explicit the financial hurdles you will have been familiar with from the last 3 years. We evaluate these together with our strategic criteria when it comes to acquisitions. We think at Ansell we have a very disciplined M&A process and will not compromise that going forward. It's served us so well. And also in this slide, you can see we have a solid track record when it comes to dividend payments over the last 17 years. And this has been coupled with nearly 15% of our issued share capital being bought back since fiscal 17. So overall, we're very pleased with this framework. We believe it strikes the right balance between supporting growth on the one hand and returning cash back to our shareholders on the other. That leads me to wrap up with our medium-term financial targets. So again, beginning with organic revenue growth, we've maintained the 3 to 5% per annum targets, but of note here, and I indicated this in the F20 earnings call, we do expect organic growth in fiscal 21 to be notably higher than this 3 to 5% range. But when we look beyond the range or beyond the year, we expect to normalize back, but very much off a significantly higher sales base in fiscal 21. So the combination of increased sales volume, pricing, operational leverage and efficiencies, further accentuated by our CapEx investments, has led us to increase our earnings per share target from 5 to 10% previously to now 6 to 12%. And that's with the assumption that our raw material pricing or costs remain fairly flat as they are today. And even in spite of probably a higher tax rate and most likely higher interest costs as we look out over the medium term. As I mentioned earlier, we'll also continue to focus on the quality of earnings and cash conversion. And so you see here we've set a target of between 95 and 100% in terms of cash conversion as well. And then finally on the slide there, you see we've maintained our return on capital or ROCE target at 14 to 15%. So, all in all, and similar to the last 3 years, we do see a solid and good path for shareholder value creation if we can achieve against all of these targets, and so we do look forward to that execution. That leaves me to thank you for your time and your interest in Ansell, and with that, I'll hand back to Magnus Nicolin, our CEO, who will provide some concluding remarks.
Good afternoon to all of you in Australia. And it's a pleasure to switching gears here into a more live presentation, but above all Q&A. So we're going to go to Q&A very briefly. I have a couple of slides just to sum up what we have shared with you this afternoon or this morning, depending on where you are. And the first page really lays out on one page the strategy of the company, and you've seen this in a version before, where we talk about what we're strive to be and how we will drive to gain share and demonstrate industry leadership. A couple of key elements to make that happen, so to speak. We have also highlighted the specific targets that we have for the company. And in Zubair's presentation, he again reinforced the 3 to 5, but reminding all of us that we have previously guided that this year is going to be significantly above on the top line growth number. And then going forward, we expect the 3 to 5 to be the norm, so to speak. But we are also, as you recall, upgrading our EPS growth to now 6 to 12 over the coming period as an average. And ROCE slightly improving further, and with strong cash flow conversion, then using that cash in those 5 streams of deployment that we have illustrated before. So if we go to the next page with the key takeaways, and certainly what I take away, and having been here for quite a number of years, I think we've never been in a stronger position than we are now. And what I see is, first of all, a very focused company. We are safety. And that focus allows us to be really good at what we do. Our 8 dimensions of differentiation gives us a roadmap, if you will, to really focus in on what do we focus on next to make sure that the moat around Ansell makes us even stronger tomorrow than we are today. So that's a really good guide for us. The foundation that we've established is really strong, with innovation pipeline really full, and we've actually throttled back on some product launches in the last year or in the last 6 months, especially with COVID sort of getting in the way, and where we needed to focus all resources on just getting max product to market of certain types and so forth. But innovation is going to resume with a vengeance over the coming period. And of course, digitalization. Every company is going through it, and we are as well. And we're investing significant effort of key leaders to make sure that we make the interface to Ansell easier to navigate, and that we have a better and more direct dialogue with the end user, if you will. Capacity expansion has been the big focus recently and going into the next 9 months. We are starting up 3 times the number of new lines in the coming during this year than we have ever done in our history in 1 year. So it's a very significant commitment to capacity, and we're building that capacity because we have demand and because we have confidence in the future based on the strong performance of the company and the reach that we're now having with our bigger sales forces and success in emerging markets and so forth. Supply chain is still requiring further work. We do not deliver the best-in-class service to all customers, and that's really where we're doubling down now to make sure that we will deliver that. We will continue to deliver cash, and we will continue to leverage an amazing sales and marketing and production organization. People across Ansell are unbelievably passionate about what we do and our role in society, if you will. Finally, we deliver on our promises. We have delivered on our promises over the last few years. Since the last Capital Markets Day, we intend to deliver on our promises going forward. And I think we're in a really strong position to do that. And that in turn will deliver strong returns to our shareholders. So the final page shows the people you have seen on the various videos. And we will now go to Q&A, and obviously feel free to direct your questions, or we will share the opportunity to answer your questions between us. But this is your opportunity also to get a feel for the rest of the management team, whom you do not normally interact with. So go right ahead. And Anita, over to you to sort of manage the Q&A.
For those on the conference call, please press star to ask a question. So there's a few questions on the conference call. First up, we have Vanessa Thompson from Jefferies. Vanessa, please ask your question.
Thanks, Anita. Thanks, Magnus. I was wanting to ask, in the healthcare GBU, are you seeing increases in average selling prices in excess of the pass-through of any cost input increases?
Yeah, let me start that one, and I'll ask Daryl to comment on it as well. We have been very deliberate about how we do our price increases. We have certain competitors and suppliers out there who've been very aggressive, in our opinion, to the point of price gouging. That's not what we do. So what we have attempted to do all along is to pass on cost increases to customer, as opposed to seeing it as an opportunity to reap extraordinary rewards for a short period of time. So for that reason, we do not expect to see a margin lift, but we do expect to protect the company from the effects of the cost increases, whether they are based on OEM manufacturers or based on raw material costs going up and so forth. Daryl, what else would you say to that question?
Yes, thank you, Magnus. I fully support what Magnus has said. Our number one strategy is to just recuperate the significant cost increases that are present in what we're seeing. We have been very fair with any changes that we've made to our price structure in the market, and it's been in line with either raw materials or any pass-through costs that we incur. And then we communicate that pretty fairly to our customers. In most cases, we are significantly lower in terms of the magnitude of our price increases versus some of our bigger competitors that are out there.
So next up, we have Sean Lehman from Morgan Stanley.
Thank you, Anita, and thanks for the opportunity. A couple of questions, because I noticed in Renee's presentation, she talked about sort of looking after some of your key customers through allocation, and John's presentation, he talked about sort of making sure you sweat the assets hard enough to accommodate sort of short-term demand shocks, as well as making sure you've got enough room there for long-term growth. But trying to pull all that together, I'm just wondering, what's your sense of the degree of permanency to the market expansion as a result of COVID? Should we expect kind of a roll-off of growth and a rebasing it at some point forward? And if so, how do you manage that? And, the second part, if you are sort of allocating product to key customers, I assume your competitors must be doing the same thing. So ultimately, is that going to drive a change in the structure of the customer base? Are you going to see customers that can't get product and essentially go out of business, for want of a better term?
Yeah, good question. Let me start as well, and I will ask Ricard to add in on the customer base shifting a little bit. The first and really core question, and obviously on everybody's mind, your mind as well as our mind, is what is the level of permanency of the COVID effect, if you will, and are we going to hold on to a lot of this? The answer is yes, not entirely, but for the most part. We're seeing customers adopting new protection protocols, and they will stick with those customers and with the market for quite some time. So that's going to be a driver that's sort of permanent, if you will. And those protection protocols essentially mean changing gloves more often. It means people who did not have gloves in the normal course of their duties now are asked to put on gloves, or in some cases suits and other protective equipment. So there is a change in behavior. We're also seeing it in the hospital or healthcare environment where the intensity of use is higher. And once people get used to that rhythm, it tends to stay. Another driver here is that there are significant differences in glove use per capita, region to region. And we're seeing COVID being sort of a reminder to people around the world that this is a really good way to stay safe. And Asian use of gloves is increasing rapidly, and the level of use per capita is way below the US, for example. And we expect that it's going to catch up with, just like we have seen over many, many years, an evolution or a trend where a market, as it matures and evolves, protection becomes more important and glove use increases, glove use per capita increases. And we're seeing COVID being an accelerator or a driver of that effect and taking shape in many emerging markets around the world. So those are a couple of observations that would lead me to believe that a high percentage of the step up that we're seeing at this point in time will stay with us. When it comes to price increases, which is another driver of revenue growth here, it's going to be less permanent, I believe. So there will be a step down at some point in the future when we reach balance between supply and demand. And this primarily affects the single use, where sort of 80–90% of the pricing action is at this point in time. So let me stop there, hand over to Ricard if you want to comment on the other side of the question.
Yes, thank you, Magnus. On the allocation side, so yes, we have gone to a quota allocation for our customers, and the purpose and the strategy here has been to really protect our loyal existing customer base. So that means that we have not really been keen to take on new customers, but rather protect existing customers. And also for the existing customers to, we've had to give them a quote on how much is available for everyone to purchase, so that we know that the next customer also will get their fair share of product. Now, as we going forward start to see an increase in our production volumes, then we're going to be very strategic about this, and rather than perhaps maximizing short term just on price, we're going to look very much on the end user situation and where we feel that we can strategically and sustainably gain new business.
Thank you. If I can squeeze up one more in, I'm sorry. Just on slide 85, Magnus, you talk about the 6 to 12% EPS growth target. Just to clarify, is that for fiscal 21 or is that an ongoing target?
I don't have the page number in front of me, but in our sort of long-term guidance where we say 3 to 5 and 6 to 12, that refers to the long term, much like we did in 2017 when we had our last Capital Markets Day. We said 5 to 10, and then we delivered 17. I can't promise you today that we're going to over-deliver by the same margin going forward, but clearly we're stepping it up a notch because of the confidence we have gained through the transformation program, where we now have a much more efficient manufacturing apparatus, because we have a stronger presence in many markets, because we have gained share in a number of areas. So there are a number of reasons leading up to that. So the 6 to 12 is a average over a period and, or if you will, a long-term guidance. We will obviously guide and continue to guide for the current fiscal year, as we have done in the past, and as we did in our results release in August, and probably we'll talk to as part of AGM, the AGM meeting coming up as well.
Great. Thank you. Thank you for the presentation too. It's been great.
Thank you.
Thanks, Sean. Next, we have Gretel Janu from Credit Suisse.
Thanks, Anita. Hi, everyone. So just firstly, just on the medium-term target for organic sales growth of 3 to 5%, for both industrial and healthcare, you have stated that you are well positioned to grow ahead of market, yet you're still only targeting 3 to 5% sales growth. So I'm just wondering whether that is too low, and you actually think you can achieve towards the higher end of that.
Yeah. It's a good question, and one that we have been debating as well. A couple of factors that comes into play. First of all, we have said that this year, F21, we will grow significantly above the 3 to 5. So we said that as part of the annual guidance. What we're talking about here is sort of the longer term guidance, 3 to 5. But even there, as I indicated in the previous answer, we believe that we will hold on to some of the step up here, and that we are seeing new safety protocols would seem to indicate an opportunity to grow faster. You also heard from both Neil and Daryl a high level of confidence in their respective businesses, and that we're positioned to grow in line with or better than market. So that would indicate some opportunity as well. But we were faced with or asked to provide a long-term guidance, and into that guidance we also need to incorporate the fact that we're going to see some normalization of pricing, and that we're going to see some normalization of the extreme levels of demand, and that will sort of come in F22, F23. So since that's in the period that we're talking about here, we wanted to sort of weigh that in with all of the positive factors, and that's why we still landed on 3 to 5. When it comes to us, we will obviously focus as a management team to drive towards the upper end of that, and you can take that as a given.
No, thanks, that's very helpful. And then just on manufacturing capacity, do you think the wider industry is doing enough in terms of adding capacity given the higher demand? Or like potentially is it doing too much where in a few years' time post-COVID we could get into a position of excess supply? So just wondering your broader thoughts on the market here.
There's massive amount of capacity being added, and I will ask John to comment on this in a minute. But what I wanted to say before I hand over is for Ansell, we're in a good position because we're adding a lot of capacity on surgical and single use and chemical body protection. And in two of those areas, we have significant manufacturing in-house, but we're also outsourcing. This gives us a lot of capability to balance load, so that if demand were to go down in the future, we can insource more and therefore get the efficiency we need on our plants. So we're going to be balancing this carefully as we go forward. And I think therefore we are in a better position than, for example, an OEM manufacturer who is building a lot of capacity and hoping that they can sell all of that capacity when demand at some point in the future starts to moderate or even go down. So I think Ansell is in a really good position here, and we're all but assured that we can get a good return on these investments. John, what else would you say to this question of enough capacity and what's going to happen next?
Yeah, so I think just taking the individual sectors, so particularly an exam, which has had the biggest single increase, we can definitely see lots of capacity going down in Malaysia, also in some new countries. So China is putting a lot of capacity through. Ultimately, as Daryl said in his presentation, The ultimate bottleneck is around material supply, and that comes at a longer lead time. So we think that's going to come in through calendar year 21 and 22. But also there are other factors, labor availability and environmental availability of things like water, etc., is again probably will slow some of that sort of capacity on board. As Magnus said, look, we've got a broad-based strategy of what we produce, what we make, and what we buy in, and therefore that will insulate us in terms of being able to make that rebalancing approach. And we're making broad-based investments. So not just an exam in surgical, as Daryl talked about, with the core, as Neil talked about, going after those fast-growing sections in mechanical and in chemical. So again, we've got a very broad approach to what we do. It'll give us a headspace for that long-term as well as the short-term volatility. But again, looping back into exam, it's not just about putting lines in a factory. It's making sure the raw material supply, labor supply, water supply is all available. And again, we're starting to see an interesting dynamic about the relative global capacities in the market across Malaysia, but also now sort of rising in China and other places.
Excellent. Thank you very much.
Next, we have David Lowe from JP Morgan.
Thanks very much. I've just got a few questions, but just on the capacity issue that we've just talked about. Magnus, I heard the comment that you're adding 3 times as many lines as you've ever added before. Could you quantify it all? Or is there any quantification out there in terms of how much additional capacity Ansell's bringing on this year?
Yeah, let's ask our 2 GBU heads to comment on it, because we're adding capacity in both areas. So Neil, if you want to start on, and obviously you're adding a lot of capacity on the chemical side in particular, but even on the mechanical side in some fast-growing categories. So it might be good to provide a perspective on that. So go ahead, Neil.
Yes, sure. So 3 main areas that we're adding capacity in industrial. Chemical protective clothing is the product range that's most in demand as a function of COVID-19 demand, and there we're on a path to doubling our capacity of that product line. And then even beyond the COVID-19 related demand, we see significant share gain opportunity in industrial settings for that product line. So this is capacity for the long term rather than specific to current demand trends. Within the hand protection portfolio, we had a plan already to expand chemical hand protection capacity. We have used that capacity now more to chemical reusable products that are an alternative to single use for customers who cannot get sufficient single use. And in fact, often in many cases, we feel it's actually better to use a reusable product. You avoid the waste issue, which is now commented on with regards to single use gloves. And it can be, in fact, a cheaper product as you're using 1 pair for a whole day as opposed to multiple pairs of single use. So chemical hand protection, but then also within mechanical, although our volumes of cut are down linked to the manufacturing cycle that I mentioned, we are seeing strong demand for more general purpose gloves, and particularly our DGX technology, which we're rolling out across a range of general purpose gloves that give market leading durability. So we've expanded capacity on those lines as well. So I can't give you exact numbers, or won't give you exact numbers, David, on all of those, but they're all key components to the growth aspiration that I talked about for the IGBU.
And it's obviously a lot of excitement for me to observe Neil get so excited about the opportunity and the upside. It's a little bit of a different style, but excellent to see. So Daryl, since we have commented quite a bit on single use already, maybe you want to focus a little bit more on what we're doing in life science and surgical, where we see a lot of opportunity and excitement as well.
Yes, thanks, Magnus. In surgical is an area that we've seen some good acceleration in fiscal year 20. At the start of fiscal year 20, we had planned to add capacity on our synthetic product lines as well as our natural rubber latex product lines, and we're in the process of executing that, and that should be in place before the end of this fiscal year. In fact, they'll start up in January. And so we have seen significant volume improvement in these product lines, and we are winning new business, and that capacity that is coming online is really going to greatly strengthen our synthetic portfolio as well as our natural rubber portfolio. We're growing in our mature markets with synthetics, growing in our emerging markets with natural rubber portfolio. On life sciences, is doing really well these days for us. It has been on a growth trajectory for a few years now, but we've seen a significant acceleration most recently, and it's going to continue. This is a very sticky business, and some of it has taken us by surprise in terms of the demand. A lot of our life sciences products are derived from surgical products that are cleaned and sterilized and made suitable for life science applications. And we're experiencing very, very good life sciences growth. So we're adding more life science capacity in areas like clean room, packing capacity, in areas such as our isolator, glove capacity, as well as in our garments. So, a good amount of capacity additions also in life sciences. Okay.
Good. Let's go to the next one. You said you had a couple.
Okay, if I could just, I'll just one other. I mean, you talked, and so there's obviously been questions about the ASPs in single use. It would seem to me that if you're lifting just to cover the costs and you're seeing organic growth significantly above, it naturally means that margins are going to be lower this year than would otherwise be the case. I just wonder if you could sort of let me know whether, one, that's correct and we're likely to see it in the numbers, and two, what do you think the sort of trajectory is going to be there on margins given those dynamics, please?
So yes, and that's what we also said as part of the August results release, that we were passing on to protect dollar margin, not percentage margin. So there will be, we think, some effect, but we're doing quite well in executing on these price increases to protect us. But maybe Zubair, you want to comment on this? It's obviously high on your agenda every day to make sure that we keep track of this and don't lose our way here when it comes to driving margin preservation and obviously in many businesses, margin growth. So this is a single-use story that we're talking about now primarily. So Zubair, what do you think?
Yeah, thanks, Magnus. So I would say, David, as we consistent with our earnings guidance, we did indicate then, of course, when you're passing through price and the cost is equal to that price, just the math will get you a natural dilution in your GPAID margin and therefore your EBIT margin as well, especially if we didn't offset that with SG&A. So I think the question was very direct. I'll answer it directly. Indeed, your assumptions are right. Now, equally though, that doesn't mean we're sitting on our hands here allowing that position to happen. We finished the year, if you recall, in F20 with a 34.5% thereabouts GPAID. We would like to preserve as much of that as possible, and the way we can influence that is through mix. There will be foreign exchange uncertainties that may impact that, but overall, if we can shift some mix elements to higher margin categories in the rest of the business outside exam single use, and I'm talking things like surgical growth, life sciences, as Daryl mentioned, that will certainly help. But if we are preserving the customer allocation and all the methodology you've just heard clearly today, there will be a dilution. Now, whether that's 100 basis points, 200 basis points, it really depends on the cost that's being passed to us through outsourcers. So we've not been able to really hone that in yet because there's wave after wave of pricing, almost monthly dynamics going on there.
The other point to add, obviously with the volume growth and the total revenue growth way above our 3 to 5, and the fact that we're spending a little bit less on SG&A growth because we're not traveling and as much at least. So you're likely to see perhaps a small degradation on the GPAD line, but probably not, and unlikely that you would see it on the EBIT line. And the reason is what I just mentioned, the various elements of the P&L here. So I think we're in a good place. We're on it, and we're not about to give away the store. So I think we know what we need to do, and we'll execute accordingly.
Great. No, that's actually very clear. Thank you. Look, one last one from me. We heard about the transformation program. We saw various sites get shut. I'm just wondering now that I see that new manufacturing facilities are being opened in Russia, etc. It seems a bit of a contradiction. I was wondering if you could just talk to that about how we reconcile those two decisions, please.
That's a good question. And yes, on paper, it's a contradiction. Here's what's happening. So we closed 3 sites that we felt were not going to be an efficient part of a long-term solution. So Mexico and Korea. And the reason why we're opening facilities in, for example, Russia is not to replace in terms of size and scale a Korea or a Mexico, but to have a relatively small facility, allow late stage differentiation. It can be a facility that can do import bulk and then pack and ship to market. Yes, we will do some fully integrated manufacturing as well, meaning dipping and packaging of certain styles. They're particularly well suited to the Russian marketplace. So it's a nice complement to what we're doing, and with the transformation we got to fewer sites, and we have now doubled down in those sites with massive investments that we talked about earlier. So the Lanka site, the Vietnam site, Bangkok site, and so forth are now dramatically bigger. So picture a world where you have 5 or 6 global centers that are huge, and then you have a number of satellites around the world for different purposes. And in the case of Russia, it's really important because if you don't have a made in Russia stamp or image, if you will simply not be an effective supplier to the Russian marketplace, where so much is linked into government business, whether it's Gazprom or the mining industry and whatever. So you really need to respect some of these countries' desire for locally manufactured. And on top of that, of course, we're getting a new wave of discussions related to COVID. A lot of governments were caught short, and they're essentially coming to us and asking us, couldn't you guys build a plant in Europe or in the US so that we have a much better ability to respond to the next crisis? And that's an ongoing dialogue, and that's something that we are carefully assessing. Because obviously, we simplified the footprint and we went to our most efficient location for a reason. And we don't want to lose that by starting up a lot of plants all over the place, and that's not what's going to happen. So let me stop there. If any one of my colleagues wanted to add anything to that, please feel free. Okay.
Said it well, Magnus.
Reasonably complete
that
answer.
was clear. Thanks very much, everyone. Thank you.
Thanks, David. So next we have John Deacon-Bell from Citigroup.
Thanks, Anita. I just had a couple of questions. Just Magnus, first, just to clarify, you're in that longer term EPS target of 6 to 12%. Is that inclusive of buybacks and M&A, or is that just leverage from the organic revenue growth that you've indicated?
It is based on the core business. We are not making assumptions on M&A. It's virtually impossible to predict when and if and how it's going to happen and what the effect is going to be. When it comes to buyback, we have a live buyback program. but we haven't been executing against it for the last little while, but it doesn't mean that we won't. But we haven't specifically factored in effects from a buyback that we don't know. So yes, the simple answer is this is the core business that we're making these assumptions for.
Thank you. That's very clear. And just talking about M&A, I thought it would be helpful for you just to reflect back to that 2017 Capital Markets Day when you had a very robust balance sheet, sexual wellness was sold, and compared to what you thought then, have you done more or less M&A in the last 3 years?
Well, it depends on what you compare with. If you compare to our hopes at that point, it's probably less. We've done, I think, 4 deals in the last 3 years. And the biggest one was Ringers. So we're happy with the acquisitions we have made. We would have loved to be able to make more, but also note that we have taken a look at maybe 10 other opportunities during this time and decided for many different reasons not to proceed, either because it was too expensive, or because it wasn't a good fit, or because it didn't add any new capability to Ansell that we didn't already have, or new geographical coverage that we needed to get, or anything like that. So I think in that sense, I would have loved to do more, but we are always going to be quite picky when it comes to what we do and how much we pay, because we want to get a good return, and we have a great track record on getting a strong return on our acquisitions. So when we're now looking forward, which is going to be the implied follow-on question, I guess, what is that going to look like? Well, there hasn't been a lot happening on the M&A front in the last 6 months for obvious reasons. But we do expect that as the COVID situation settles down, there will be a lot of companies coming up for sale, whether it's private equity owned who are going to be thinking it's time to get out or turn the portfolio, or family-owned companies where either they were hard hit by the COVID crisis and they don't see a way back, or it could be companies who actually did quite well during COVID and now is a good time to get out. So our expectation is there will be quite a bit coming to the market over the next year. And we, of course, are going to look at all of it and use our normal filters to assess what to do and what not to do. So hopefully that gives you a perspective on it.
Thank you very much. And if I could just ask one more of Neil, I just thought it might be interesting, given that Neil was in the business for a long time in the finance role, you've been in the industrial operations role for a little while now. Is there anything that's kind of stood out or surprised you, having been in the role, that is different to what you thought when you were looking through the finance lens?
John, thanks for the question. No fundamental surprises, no. I think the view I had as CFO is confirmed now that I'm within the business. But I think what's reassuring is that the potential that I always felt as CFO that was in industrial that we weren't fully realizing for sure is there in the business. And there's 2 aspects to that. One is the growth potential that I talked about, but also I feel the foundational work that we have largely completed, still have some work to do, will be a key enabler to growth. So we talk about that work as benefiting transformation and delivering the cost savings, and it has, with still some savings to deliver. But by executing more effectively against the potential we have in the business, I think there is significant upside available to us. And we talk about the cost benefit of simplifying the manufacturing footprint. But to me, the bigger prize is actually what it now enables us to do. And John was describing that with regards to those productivity programs. We couldn't have done that with our larger, more fragmented base. We now have the opportunity to do it with our more consolidated base. And that will continue to drive productivity, but it also means we'll execute better to the market. So we have this terrific innovation engine, which is continuing to bring great new products to market. But by executing more effectively, we can realize value from that innovation engine at an accelerated rate to the future. So degrees of difference, in my view, rather than any fundamental shifts. And I'm very excited by the potential that we have in the industrial portfolio.
Thanks, Neil. Thanks for taking my questions.
Next up, we have Sal Hedison from UBS.
Sal?
Thanks. Just one quick question from me. Again, just referring to the medium-term targets as it relates to sales and EPS growth and ROCE. The maintenance of the ROCE target, despite the modest uplift in EPS, that's just reflecting the higher capital intensity over the next couple of years. And on that point, regarding the CapEx and the comments for FY22 to also be elevated, do you expect then CapEx to fall back down in dollar terms back to a level that we've seen in the last few years, or do you think it stays elevated at a higher level for a long time? Thanks.
So we said in August about 100 million for F21 and elevated levels also for F22 without being very specific. We can confirm that today, that yes, F22 is going to be elevated as well, because we now have better visibility of that. F23 then, I suspect it's going to be a little bit less, but at the same time, as we're making these investments and as we're innovating, we're sort of finding new opportunities and opening new doors to other areas that we had not fully realized how big they could be because of some early successes that we're seeing in some subsegments and so forth. So I think it's not unlikely that it will continue to be a higher level of CapEx because we have really strong momentum in the business, and to feed that momentum, we need to continue to develop capacity and new capabilities. The other thing that is really a key focus area, and I'm going to ask John to comment on this, is automation and productivity. And maybe one or two words, you commented on it, John, in your presentation, but maybe in light of this question, how much are you going to need to spend on robotics and smart tools in the plants in F22 and F23?
Yeah, so good question. Thank you, Magnus, and thanks, Sal, for the question. So from a capital point of view on productivity, it's tripled over the last sort of 18 months. So what we were typically spending in savings area, we see that tripling, and then as you saw in the presentation, we've got a fairly robust pipeline in terms of the benefit and the degree of difficulty that we have. And then coming back to what Neil said, one of the other things that we can now act with pace is we can replicate all these different solutions across our network. So we're seeing a tripling of the investment level, and that's with us. And as Magnus said, the more you look, the more you can find new ideas as you sort of eke away at the productivity piece. And as I said in my statement, in the presentation, also in the question before, labor availability is definitely going to be a macroeconomic constraint, I think, within the market and within many of the typical lower cost manufacturing locations. So that paradigm has definitely shifted. So therefore, we've got to continue to go for that level of automation. Also, sustainability. We're continuing to make bigger investments in, again, as I talked about, to manage those inputs, to reduce our footprint. And we're looking, and those are longer term investments that we've got to pay, as well as taking capacity opportunities at a lower level technology level. So productivity tripled in the period. I think we're going to see more and more because we're looking for a step change in productivity, but still we've got a long way to go. And then I think things like sustainability are going to continue to need longer term investments in respect to our longer term strategy and the needs of all our stakeholders.
Yeah, so just one thing I would just add there, just one thing. So as what Magnus and John say, of course, the CapEx spend, when we're modeling that ROCE number, as you say, the 14 to 15%, we do expect an EBIT return on that, and we've said, we often have high returns when we spend CapEx, so that will keep us in that swim lane. But then when you look really long term, you will see a normalization back. So when you're modeling like we are modeling into perpetuity or the really long term, you will normalize back to a CapEx, which is in our historical maintenance rates that we've shared many times. So that's how we're thinking of it. But in the next 2 to 3 years, of course, we'll take the opportunity to assess productivity and innovation and capacity expansion, as Magnus and John have outlined.
I want to ask Amanda to comment a little bit on the labor point. John alluded to the challenge in labor and labor development, foreign labor, and all of the rules relative to that, and the standards that we have at Ansell, and the sustainability side. Both of those aspects will have an impact on the amount of money we should spend on CapEx. So maybe you want to comment a little bit on that, Amanda?
Yeah, thank you. Thanks for that question. So very much, Ansell's been in this for a while, and we are very clear that we are going to kind of lead where we can on the standards and help the industry through. So we do see that from a sustainability side that will continue to play a part. So you will see a continued increased spend, I would say, as we understand more, learn more. You've seen the stuff that has been in the press recently, I'm very sure. And Ansell had already agreed to settle on some matters and haven't been in the press, but we are very much trying to drive this across the industry. The foreign workforce are essential to us, but it is essential that everybody that joins us is doing so on the basis of coming freely, and that there are absolutely no hint of any modern slavery, and thus I'm working very closely with John in operations about how we can really build that employee value proposition out for our production heroes, so that they not only come and do a job, but they learn, they grow, they take that back at whatever point to wherever they go for the future. So that in itself is part of our what we talk about sustainability on the human side as we push it out.
Yeah. And on the broader sustainability, big investments in biomass boilers and solar power panels, on water reuse. We're investing in reverse osmosis to make sure that we can reuse a high percentage of our water multiple times. So these types of areas will require higher levels of CapEx, and that will continue for quite a while. But Zubair's comment still is correct, that it will come back into normal, and for modeling purposes, probably should be assuming it coming back into the 50 range in the certainly by F24.
Thank you.
Yep.
Next up, we have Andrew Goodsall from MST Marquee.
Thanks very much for taking my question. So I know you flagged you'll have a trading update at the AGM, but to the extent you can, I was wondering if you could just give us any further colour around the first quarter trends that you've seen, particularly around continuation of COVID. I know you've touched on raw material, but any thoughts around what happens when nitrile sort of exhausts, or where that's trending? And then just from Zubair, any trends around working capital that you've seen during this period?
Let me start. Generally, we are executing well against our plans. Company is doing well. There are no significant negative surprises. We are winning in the marketplace in a fairly significant way in a couple of segments, converting competitor accounts to us and so forth. So from that point of view, we're happy with the start to the year. when it comes to the balance sheet, we have been building back some inventory because we were towards the sort of tail end of last fiscal year. We were running into very significant back orders on many different products, driven by extreme COVID demand. And we've been looking to build back some of those inventories. But Zubair, how substantial is this, and should an investor worry about that?
Yeah, so in terms of working capital, I'll answer it this way in terms of the three components. So inventory, as you've just heard Magnus talk to, we are rebuilding inventory. This is a decision we will take to ensure our service levels are still very high. Obviously, through this pandemic, we have to maintain that service level, and it's somewhat hand to mouth in the exam and single-use business. But on the rest of the business, what we learned in the last global financial crisis, of course, there isn't that close a parallel, but there is in some regards, is that when you see coming back out of a softness, let's say in aerospace or automotive, the best place to be in is with very good inventory levels that you can really service the customer well coming out of any dip in that sort of market. So we're being very strategic around inventory. We will invest in that. It's nothing for investors to worry about because you get a commensurate return in sales and earnings on the other side. And overall, you should see a positive cash flow. In terms of receivables and payables, receivables is again an investment in the business as we grow the top line. So you will see let's say if the top line grows 5%, you would see a commensurate growth in receivables. Now on the payables side, that will probably be a reflection of the pandemic-driven activities at the outsourced supply chain again, because where they have power on pricing, they also can drive different terms on payment. For instance, they could ask for cash in advance or shorter payment cycles, and that's something that's less within our control, and we will monitor closely. But overall, working capital, it may be a little bit higher than you may have seen in the past. But again, that's something we are controlling, and we don't expect it's going to be a huge cash drain because of the, like I say, the profits and the sales that we get on the other side. Hopefully that's clear.
And just to close on that, obviously 118% cash conversion is not something you can do every year. And part of the reason for that fantastic result, if you will, is that we were drawing down inventories, right? And that's also why we're guiding that 95 to 100 is what you should expect from us, not 110 or 120. That's kind of extreme.
And thank you very much. And just a follow-up, just in terms of yourself, Magnus, you've been fundamental to the company for quite some time, and obviously you've extended your time there across this, this incredible period. But just turning to sort of, I guess, the medium-term objectives that you're setting, just trying to get some thoughts from you around how you see that transition, particularly transfer of the ownership of those objectives and execution.
Yeah, well, obviously, ultimately goes to the board, and the board asked me to stay a little bit longer, and the reason is COVID and the board's desire to be very close to the process and working very closely with Neil and Daryl in their current roles, and also in assessing their readiness to step into this role. So that's working really well. I think you're seeing today on this call and in these presentations that we have two incredible leaders who will be more than ready to step into this when it comes. The other factor here is that both of them have been with Ansell for many years. They know the company as well as I do, and while they may have slightly different philosophies or beliefs about the direction, I don't, and I don't think the board expects any dramatic course reversals or anything like that. But in the end, that's a board call, and that's why it's welcome for all of us that the board is very close to the company and through this time, through COVID times. I think what we've seen is we have more board meetings, but shorter board meetings. So the intensity of how we manage the company and how we assess and develop and take decisions and so forth at the board level, at the management level, and multiple levels through the company, the intensity is higher and the agility is higher, and that's a good thing. So I think we'll be in a really good shape when we transition, and I don't think the company is going to lose a beat, and certainly I'm expecting to remain a major shareholder after I leave, so I certainly don't want to see us losing that beat, and I don't think we will. So I'm super happy with how things are developing, and also beyond Neil and Daryl, the strength of the leadership team. You're seeing some of that on this call today as well. We have a few more ELT members or global leadership team members who are equally strong as the group you see in front of you, but we're in good shape, and we will continue to deliver.
It's a great answer. Thank you for that. And you can definitely see the strength of the bench there today. Thank you.
Thank you.
And thank you. To end, we have Vanessa Thompson from Jefferies again.
Thanks again, team. I wondered, just to close, if you could talk about Ansell's approach to outsourcing, and in particular, how you manage compliance with labour rights from outsourced suppliers. Thank you.
Yeah, so first of all, our basic strategy on insourcing versus outsourcing is that if the product is differentiated, if it contains a significant amount of Ansell trade secret or patents, we prefer, strongly prefer even, to manufacture it in-house in one of our plants. If it is a product that is more basic, it will still be a good quality product. We will not sell a bad quality product in this company. But if it's more basic, a little bit less differentiation from most competitors, we often outsource. So that's the principle. When it then comes to the outsource, we expect our outsource providers to live up to our high expectations that we put on our own plans. They also need to live up to them when it comes to labor practices, overtime hours, recruitment fees, standard of living in housing provided, don't hold passports, and those kinds of things. So we track them to make sure that they do live up to that, and we send in auditors to make sure as well. And if they don't, they are given a warning and a short period of time to correct it. And if they don't correct it, we will exit and move on to somebody else. Through COVID, we have seen certain of our suppliers act up, and they may be compliant on labor practices, but they are starting to take unjustified price increases or behave in other ways that are not up to our standards. And that, of course, is another reason why we would look at exiting some of those suppliers as soon as we can. So we have high expectations and demands on our suppliers. Maybe if I can ask Amanda again on what exactly, how do you make sure that a distant, medium-sized, smaller supplier in Malaysia or Indonesia is actually doing what they're saying? How do we know?
Yeah, thanks for that, Magnus. I think you covered the main points, which is, it starts with our own behavior and standards, and then making sure that we then audit. So we do third-party audits of all our suppliers, and having that independence of somebody else looking at it. Of course, COVID has made it quite tricky because rightly, and we've been the same, your manufacturing plants, you want to protect who comes in and out to minimize the risk of infection. So we've had to develop virtual auditing ways, but we will of course get back into going in physically as soon as possible. And it covers, as Magnus indicated, work hours, rest days, foreign worker hiring practices, human rights aspects, including, and you've got to think about aspects around trafficking and the modern slavery. So we've committed, we do our top tier suppliers every 2 years we audit, and we're just working through end to end to make sure that, you know, right the way down the chain, we've got all of the necessary pieces in place. And also, as Magnus said, it's a question of, you know, we are working to try and help folks. We want to raise the standards of employment across this industry. And therefore it starts with, okay, we found a problem, let's try and help you solve it. But if you go back in and find that you're still having the same issue, then it's a different conversation. But really trying to help first. Sorry.
Building on that, I wanted to ask Ricard to comment as well, because this is not just a strong conviction that we have. We actually have customers who are increasingly demanding of our practices and our partners' practices. Maybe highlight a couple of examples, Ricard, on that, and why it's so fundamental. It's not negotiable ever. Why is that?
No, absolutely right, Magnus. Many customers, and there's a little bit of a geographic spread. We see more in Northern Europe and in Australia, for example, that CSR is becoming top of mind for customers and something that is part of every customer discussion. Many cases is part of tenders as well, particularly in the public sector. And it's just going to continue. And we're also seeing lately that there's a willingness for customers to accept that you know, there's a premium to pay for to providers who follow the rules and do things the right way. And that's good to see.
Right.
Magnus, I think perhaps a couple of points I would add from industrial.
Yep.
So firstly, fully agree with the comments about, you know, we insist any outsourced supplier meets our standards from a CSR point of view. I think that there's another aspect of the strategy of outsourcing for IGBU, which perhaps we talk less about it for IGBU than HGBU, and it's about the resiliency of our supply chain model. And I think what we found is that because in Ansell Industrial, we have a core of manufacturing, which will always be our core. Our identity is as a manufacturer and as a branded player, and that's fairly unique in the market. But because we have some very important strategic outsource relationships, that gives us a lot of supply chain flexibility. And going forward, we still expect, or we're prepared for risk in terms of further COVID disruptions in any particular country. And then we haven't talked about tariffs yet on this call, but I expect that still to be quite dynamic. And we may see new trading relationships country to country affected by tariffs going forward. And so we have a lot more flexibility to respond to that through a strategic approach to outsourcing within the principles that we've talked about within IGBU. And I would say, compared to our competitors who are largely either wholly insourced or wholly outsourced, that mixed model that we have has proved more resilient over the last 6 months than almost any of our competitors. So we aim to build on that going forward.
Good.
Thanks very much.
Thank you.
Thank you.
Thank you. So that concludes the Q&A section of our Capital Markets Day. Thank you for your time today. In the event that you have any further follow-up questions, feel free to get in touch with the Investor Relations team at Ansell. And thank you for your time.
Thank you all for joining us today.
Thanks all. Bye.
Thank you.
Thank you.